Module number 6 is part of Dayag's chapter 4. That's on elimination of intercompany sales, cost of sales, and profits on inventories. Okay? Start ang record. Wait, start. Wait, start. Okay? So we now begin with intercompany sales of inventories. Okay? So I hope you're already in the canvas with module number 6, the intercompany sales of inventories. Now take note that modules number 6, 7, and 8 involve elimination of intercompany profits on inventories, then your intercompany transactions related to property, plant, and equipment, and the last one is intercompany dividends, which are also found in the book of Dayag. Okay, so we now have your intercompany sales of inventories. The inventory profit in inventory transfer between affiliates is computed by multiplying the inventory held by the buying affiliate, which was acquired from the selling affiliate, by the gross profit rate based on sales of the selling affiliate. Now, at the last part of the module, we will be discussing about the downstream and the upstream sales, which whoever is the buyer. Is it the parent or is it the subsidiary? Okay, now the working paper elimination entries used in preparing consolidated financial statements must eliminate fully the effects of all transactions between related companies. When there are intercompany inventory transactions, eliminating entries are needed to remove the revenue and expenses related to the intercompany transfers recorded by the individual companies. The elimination ensures that only the historical cost of the inventory still on hand is included in the consolidated statement of financial position. Then we have intercompany sales at cost. Merchandise sometimes is sold to related affiliates at the vendor's cost or at the seller's cost. When an intercompany sales include no profit or loss, the inventory amounts at the end of the period require no adjustment for consolidation. So that's to the extent that your intercompany sales include no profit or loss. That's the only time that the inventory amounts at the end of the period require no adjustment for consolidation. At the time the inventory is resold to outsiders, the amount recognized as cost of goods sold by the affiliate is the cost to the consolidated entity. However, even when the intercompany sales includes no profit or loss, an eliminating entry is needed to remove the intercompany sale and the related cost of goods sold recorded by the seller. This avoids overstating these two accounts. Consolidated comprehensive income is not affected by the eliminating entry when the intercompany sale is made at cost because both sales revenue and cost of goods sold are reduced by the same amount. Intercompany sales at profit or loss. Sale of inventory to affiliates are usually marked up by a certain percentage of cost. For example, a company may mark up 50% of its inventory sales to its affiliates. Hence, the inventory costing 2,000 will be sold for 3,000. The elimination process will remove the effects of such sales in the consolidated statements. When intercompany sales include profits or losses, the working paper eliminations needed for consolidation have two goals. So number one, elimination of the effects in the statement of comprehensive income of the intercompany sales by removing the sales revenue from the intercompany sale and the related cost of goods sold recorded by the selling affiliate. So elimination of the effects in the statement of comprehensive income of the intercompany sales by removing the sales revenue from the intercompany sale and the related cost of goods sold. Number two, elimination from the inventory on the statement of financial position of any profit or loss on the intercompany sales that has not been confirmed or realized by resale of the inventory to outsiders. Inventory reported in the consolidated statement of financial position must be reported at cost to the consolidated entity. Any profits or losses arising from intercompany sales must be eliminated. So in other words, you have to record the inventory items at cost in the consolidated statement. Now, we have the downstream sale of inventory. By downstream, intercompany sales of merchandise, here it means that a parent is selling to its subsidiaries. So those made from a parent company to its subsidiaries. For consolidation purposes, profits recorded on an intercompany inventory sale are realized to the extent that we have now the consideration for a downstream sale for that purpose. Those made from a parent to its subsidiaries for consolidation purposes, profits recorded on an intercompany inventory sale are realized in the period in which the inventory is resold to outsiders. Until the point of resale, all intercompany profits must be deferred. Okay, so again, downstream intercompany sales are those made from a parent. So that's downstream, from a parent to its subsidiaries. For consolidation purposes, profits recorded on an intercompany inventory sale are realized in the period in which the inventory is resold to outsiders. Until the point of resale, all intercompany profits must be deferred. Consolidated, we have now your comprehensive income must be based on the realized income of the selling affiliate. If the intercompany sales of merchandise are made by the parent or by the wholly owned subsidiary, there is no effect on any non-controlling interest in your income uh, or loss because the selling affiliates does not have non-controlling interest. So, in other words, that applies to wholly owned subsidiary, which considers now that they have no non-controlling interest. Now we have the parent and subsidiary companies entries. The journal entries to record the above are as follows. So we have now in the books of Pitt Corporation, we now debit cash and credit sales to record the sale of merchandise of, say, company. Now, the second entry is to debit cost of goods sold and to credit inventory. So now it's to record the sale of merchandise of, say, company. The second here, we have the entries in the books of SIG. We now debit inventory, credit to cash. So debit to inventory, credit to cash. That's on April 1. Now take note that we have the entries in the books of Pitt on April 1, recording cash and crediting sales, debiting cost of goods sold and crediting inventory. In the books of SIG, on April 1, the next entry is to debit inventory and to credit cash in the amount of 10,000 to record purchase of inventory from Pitt. In other words, SAIC now is buying from Pitt. And on November 7, debit to cash and credit to sales. Now take note of the dates. The dates in the books of Pitt are now to debit cash and to credit sales. And second, debit cost of goods sold and to credit inventory. In other words, uh, the parent now is selling inventory or selling merchandise to the subsidiary. So that's why the parent is crediting to sales and at the same time debiting to cost of goods sold, crediting the inventory account, which means that the parent uses the perpetual inventory system since it uses the inventory account in contrast to the periodic inventory system when the entry to record the sale is only to debit cash and credit sales, but you do not record cost of goods sold until the end of the year when you have to make an adjusting journal entry. So this time, we have the use of the perpetual system. Again, in the books of SAIC, who we assume now as the subsidiary, debit to inventory, credit to cash. So take note, it's PIT crediting to inventory and SAIC is debiting to inventory upon purchase. And it's PIT recording cost of goods sold and crediting to inventory, but it's now SAIC again debiting to cash and crediting sales. Now, take note that Pitt also debited to cash and credited to sales, but that is a downstream sale to the subsidiary when the amount's only 10,000. But SAIC, taking the role of subsidiary, is now debiting to cash and crediting to sales, but with a difference of 5,000. So that's the profit recorded or realized by SIC being the subsidiary as the excess of the cost of 10,000 for the goods acquired from the parent. So at the same time, Pitt now, who also recorded debit to cost of goods sold only for 8,000 and credited to inventory, but SAIC, who is the subsidiary, is debiting to cost of goods sold for 10,000 and crediting to inventory. So you can see that Pete taking the role of the parent and we have SAIC as the subsidiary. The parent selling the merchandise to the subsidiary with an amount of excess the cost of the inventory to the parent is only 8,000, but it sells the goods to the subsidiary at 10,000, meaning there's a profit of 2,000. Likewise, taking the role of subsidiary, acquiring the goods from the parent at 10,000, selling the goods at 15,000. Sake also had a profit of 5,000. Now, in illustration number 1, we now have the books of Pete and Sick, and we have the unadjusted balances, and now we should end up with the consolidated amounts. Sales in the books of Pete and Sick and the unadjusted balances, taking the total. Now, for the consolidated amount, it's only 15,000. Taking this from the books of sake. For the cost of goods sold, the real cost of the goods is 8,000, now extended to the consolidated amounts column. So the real profit on the sale is 7,000 from the parent to the subsidiary and to the subsidiary to the outside party. So we now have Pitt Corporation earned profit of 2,000, sake of 5,000, and the consolidated profit of 7,000. Now, assume again that Pitt Corporation on April 1 sold merchandise to Sake costing 8,000 for 10,000 at a gross profit of 20%, out of which 4,000 remained unsold by Sake Company at the end of December. Okay? So in that case, the above transactions are recorded in summary form by the two companies as follows. So you now have in the books of Pitt, we have the journal entries 1 and 2 given previously for the sale of merchandise. In the books of Pitt, for the purchase of merchandising journal entry, the sales of inventory to outsiders is recorded as follows. So we now have the follow-up entries for the intercompany profits for the year. Okay, so take note that we have now your recording of the parent and the subsidiary entries for sales, which involves inventories with inventory at the end of the year. In other words, not all of the merchandise were sold during the year, but you had some inventories in that form. So again, in the illustration made for illustration number 2, assume again that Pitt Corporation on April 1 sold merchandise costing 8,000 for 10,000. That's for 10,000. So take note, the gross profit rate is 20%, out of which 4,000 remained unsold by Say Company on December 31, 2016. Now, the question is, what do we refer to, or to which do we refer to when we talk about the inventory of 4,000 at the end of the year? Is the 4,000 inventory referring to the 8,000 or to the 10,000 with a gross profit of 20%? So we have in the books of Pitt, we again have journal entries number 1 and 2 given previously for the sale of merchandise. So again, for that purpose, we are going to debit cash and credit sales in the books of Pitt. And likewise, debit to cost of goods sold and credit to inventory. Meaning, the first two entries, the previous entries on April 1 in the books of Pitt will still be the same. Since Pitt is merely recording the sale of the merchandise to sake. However, the inventory remains in the books of sake. Now, in the books of sake, for the purchase of merchandise, you have now your journal entry. So, based on the previous entries of sake, debit to inventory for 10,000, that's entry number 3, and to credit cash for 10,000. In other words, we still carry or use the same entry in the books of Pitt for the first entry. I mean, in the books of sake for the first entry. Again, debiting to inventory and to credit cash for 10,000. Now, how about for the additional information mentioning that out of the goods sent or sold by Pit to Say, 4,000 remained unsold by Say Company on December 31. Now let's go on with the entries in the books of Say. The first entry is to debit cash for 7,500 and to credit sales. Now, this is a given figure recording the sales of SIG for 7,500. The sales to outsiders. And the second entry of SIG is to debit cost of goods sold by 6,000 and to credit inventory. It will credit inventory only for 4,000. Unlike in illustration number 1, that it credited inventory for 10,000. This time, only credit inventory for 4,000, for 6,000 because the cost of goods sold is only for 6,000. As stated in the problem, there is an inventory left unsold at the end of the year by 4,000. So the second entry is to debit cost of goods sold by 6,000 and to credit inventory by 6,000. The intercompany gross profit in Pitt Corporation sale to SIG company during the year ended December 31 is as follows. So we now move on to the analysis of illustration number 2. When we have this selling price in the books of Pitt originally, it was 10,000, the ending inventory for 4,000. So the cost of goods sold is 6,000. Now the cost of the 10,000 originally was 8,000 and 8,000. The ending inventory times 80% cost is 3,200. Now, that involves an intercompany gross profit of 2,000. However, the ending inventory has a carrying unrealized profit of 800. So, meaning the amount of cost of goods sold is only for here 6,000 based on the selling price and the cost is 4,800. So the gross profit realized is only 1,200 and not 2,000 based on the initial illustration. We have to defer the recognition of 800, the fact that the inventory remained unsold at the amount of 4,000. So we have this analysis. Okay, in illustration number 3, in illustration number 3. Here, we have the analysis with the beginning inventory. Now that's continuing our illustration in the preceding section. Assume that during the next year, 2017, Pitt Company sold again merchandise to Sake in the amount of 25,000 at a gross profit margin of 20%. Of this merchandise, 6,000 remains in the ending inventories of Sake Company on December 31, 2017. Now, before we have the analysis of illustration number 3, let me give you the important data in the problem. Okay? Pitt, just copy, no? Pitt Corporation sold again merchandise. Okay. Uh, Pitt Corporation sold again merchandise to Sig Company. Pitt Corporation sold again merchandise to Sig Company for 25,000 at a gross margin of 20%. At a gross margin of 20%. Of this, 6,000 remains in the ending inventories. Of this, 6,000 remains in the ending inventories of SIG. Of this, 6,000 remains in the ending inventories of SIG Company. Of this, 6,000 remains in the ending inventories of SIG Company on December 31, 2017. On December 31, 2017. On December 31, 2017. Okay? So I hope you got the data which so we now go to illustration number 3. In illustration number 3, we begin with inventory of 4,000 and the cost is 3,200. The applicable gross profit being 20% of the selling price is 800. Then we add sales during 2017. Sales of pit to sake for 25,000 and the 80% cost is 20,000. So the gross profit applicable is 5,000. So we now get the totals for the selling price 29,000, for the cost 23,200, and so the applicable gross profit is 5,800. We deduct the ending inventory of 6,000. The cost of that is 4,800. The applicable gross profit is 1,200. Now, these are the applicable data for our illustration number 3. Okay. Now, after this illustration, we now go to the elimination entries. The elimination entries. What will be the elimination entries on December 31, 2017? What will be the elimination entries on December 31, 2017? Now, please copy because these are not included in our module. So, what are the elimination entries on December 31, 2017? Okay, the first entry is to debit sales. The first entry is to debit sales for 25,000 and to credit cost of goods sold. Debit sales, 25,000 and to credit cost of goods sold. Debit sales, 25,000 and to credit cost of goods sold for 25,000. Okay? So we have now debit to sales 25,000 and credit cost of goods sold by 25,000 to eliminate intercompany sales of merchandise. Then the second entry is to cost of goods sold, debit cost of goods sold by 1,200 and to credit inventory. Debit the account cost of goods sold 1,200 and credit to inventory to eliminate unrealized inventory profit. To eliminate unrealized inventory profit. Okay? And the next is to debit retained earnings on January 1 by Pitt Corporation. Debit retained earnings by January 1 in Pitt Corporation's books. Debit by 800 and to credit cost of goods sold. And to credit cost of goods sold by 800. So, to eliminate realized inventory profit. To eliminate realized inventory profit, that refers to your beginning inventory. Okay? Now, therefore, from a consolidated point of view, therefore,